A fair value gap, or FVG, is simply an area where price moves so aggressively in one direction that very little trading took place in between them. Think of it as the market just moving too quickly. Instead of climbing step by step, price jumps forward, leaving behind an imbalance. Markets would usually go back to these zones before continuing in the original direction. But before we talk about how to use FVGs for your profits, let's understand how to identify one correctly first. Let's start with a bullish example. Every fair value gap is made up of 3 candles. The first candle finishes, the second candle makes a strong bullish move, then the third candle continues higher. If the high of the first candle never overlaps with the low of the third candle, you've created a gap. That empty space between those 2 candles is what you call the fair value gap, or FVG. A bearish fair value gap works exactly the same way, but opposite. One important thing to remember is that you're not looking for random gaps. You're looking for strong displacement. So why does price go back to the FVG? If it already moved away, it has no reason to come back, right? Well, the answer comes down to market efficiency. When price moves extremely quickly and drastically, not every participant gets involved. Eventually, the market often revisits part of the move before deciding whether to continue. It's like stretching a rubber band. A sharp move creates tension. Sometimes price relaxes back into the imbalance before continuing its journey. But that doesn't mean that every FVG will be respected. But it does explain why traders pay attention to them. Not every fair value gap is worth trading. This is probably the biggest mistakes that beginners make. They immediately place a trade after seeing an FVG. Always remember that context matters. A fair value gap forming inside a messy sideways market usually carries much less significance. When price is constantly moving back and forth, imbalances are created all the time. Many of them fail. Instead, focus on an FVG that appears after a strong impulsive move. Or better yet, look for ones that form after the market breaks structure. The first retest is usually the most important. An FVG that hasn't been touched yet is often referred to as unfilled or unmitigated. This is usually where most traders would pay attention. Does price reject the area immediately? Does momentum slow down? Do buyers or sellers step back in? These reactions could provide valuable information. On the other hand, if price repeatedly moves through the same fair value gap without showing much respect, the level may gradually lose its significance. Just like any support zone or resistance zone, repeated testing can weaken the reaction. Always combine your fair value gaps with market structure. A fair value gap should never be used by itself. It is just one piece of a big puzzle. You need to have several factors pointing in the same direction. For example, let's say it's an uptrend, and then price breaks above the previous resistance level, and the bullish FVG forms during that breakout. Price then retraces back into the imbalance while holding above the market structure. Now see, you have multiple reasons to enter the trade. Number 1, the trend is bullish. Number 2, structure remains intact. And number 3, the price is pulling back into an area where buyers previously showed strong conviction. That is a much stronger setup than simply just going with the flow because you saw an FVG. So here's a simple fair value gap strategy for you. Step 1. Identify the overall trend. Step 2. Wait for a strong impulsive move that creates a fair value gap. Step 3. Make sure that the move also supports the current market structure. Step 4. Wait for price to retrace back into the imbalance. And finally, step 5. Look for confirmation before entering the trade. This keeps you from chasing the market while also avoiding low-quality setups. FVGs are not magic. They do not guarantee a reverse or if the price will continue. What they do provide is context. They highlight areas where market moved aggressively and may revisit later. When combined with things like trend analysis, market structure, support and resistance, solid risk management, this could be a very valuable addition to your toolkit. If you found this video helpful, consider leaving a like and subscribe to Trading Uncovered for more beginner-friendly lessons like this. I'll see you in the next one.